Hi, today we will discuss bullish risk reversal strategy. I've selected Bank of America Corporation stock and I have selected 1 day and I am selecting Bollinger Band and here we go. Now the strategy is simple. You follow the Bollinger Band and that's it. Now regarding options, you should follow the options according to your risk profile. Example, if you want smaller but quick profits with reduced risk, then weekly options is the best thing. You buy today with the options ending this week. Let's presume you are buying on Monday. Try with Friday expiry weekly options. If you're buying on Wednesday, try the next week weekly option expiry. That's the quickest way to make money. Why? Because usually it makes like 5 to 7 working days in between. That's it. You make money, you get out. Now in a bullish risk reversal strategy, as we discussed earlier, there are like 3 scenarios. If it goes up, you make money. If it stays between the band that you have created, you make money. That is through the premium earning. A smaller profit, but a profit. The third scenario is the losing scenario. If it goes below your put option, your lower floor level, if it goes below that, you are in loss. So these are the 3 things. Now in a shorter options expiry period, it means booking the profit faster, but it would mean far lower profit because in 7 days most of the time you will end in between the band. However, my strategy, once I will discuss it, will make your odds of success far higher. So I would recommend you, for a start, try to go with shorter expiry period. Let's say 15 days expiry period. That is, you are trading today, then after leave one Friday, the next Friday would be your expiry period. Usually 7-8 days expiry in terms of working days. You can even use 20 working days, 20 days expiry period, and so on and forth. You can even use the monthly expiry period, but that is usually far higher, so you need to plan it accordingly. Therefore, once I will be discussing the strategy, I will be telling you how each and every strategy works for you. Now let's discuss. Now I'm zooming in so that you can see it further. Now you won't be trading right now. You would be waiting. The price is within the Bollinger Band. Now if you remember the risk reversal strategy, it means we are most profitable if it goes far higher, if it is bullish, as the strategy name is, bullish risk reversal strategy. So we will wait for it to become bullish. Now it did become bullish, but I would recommend you to be bullish once it crosses the upper Bollinger Band. This is a bullish thing, but usually I won't recommend you. Now as you can see, it is bullish. Now you might be thinking, why didn't we trade it right here? Because usually we would trade once it is the Bollinger Band is contracted and it goes up. At that time it's far better than this time. Now let's see. It is still under the band, right? It falls. Now here we could trade the bearish risk reversal strategy, but usually in a fall, it is so fast that it comes back up. So your strategy of options with an expiry date in the future has far higher risk than in a rise. Because in a fall, if you look at any fall, usually it goes down 2-3 days and then comes back up 2-3 days. So if your expiry date is let's say 10 days, then boom, you are in problem because it will come back up. So now we are stuck, we are stuck, we are stuck. We are not trading. But right here, let me put an icon so that you can see it clearly. This candle, this green candle means bullish. Now green candle means it is a profitable day. It opened, this is open, high, low, close. So it opened at 1596, its high is 1623, its low is 1596, and its close is 1611. Whereas the red candle is a bearish candle, it means it opened higher and closed lower. So this candle which has closed above this top Bollinger Band means it's bullish. Right here, we can initiate our strategy, risk reversal strategy. That is, we will put the first one right here on its top, and the other option, trade below the Bollinger Band. So what we are betting? We are betting that this line which I have turned green is our bullish reversal point. If it crosses it, we can buy the option at this rate and make profits on the top. And whereas the bottom line, that is a put contract, is traded below the Bollinger Band. So we are presuming that if it falls below this point, then we are in losses. If it stays in between these points, we earn the premium profit. So basically, if the price stays in between, we earn something. It's very little profit, but it's a profit. If it goes above that, boom, we are bullish. Now let's see what happens next. 1, 2, 3, 4, 5, 6, 7, 8. Now this means if you have bought, let's presume an weekly expiry option of next week, next Friday, not this Friday, next Friday, then it would have expired either on this day or on this day. Now if it expires on this day, you get a profitable thing. You buy it here at, let's say, 1620, and you sell it at here on the close 1626. As simple as this. You get 26 cents more profit. Otherwise, you just generate the premium profit that we discussed earlier if it stays in between the band. Now you can put another contract. On a weekly expiry contract, you can put another contract. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Now this 13th means, and 7, those days, it would mean that on this day, the 30th day would be complete from buying here, according to the working days, either here or here. Now what am I trying to say? I'm trying to say that even on 30 days expiry it's good, even on an earlier expiry it is good. On an earlier expiry you have a risk that it can close here, but you can always trade another options in its place. If you trade it here and you earn, let's presume, 5 cents on the premium profit, then you can simply trade once more, again the two options at the same rates, and let the price run away. Now this is a brilliant strategy, as long as it is going bullish. But once the Bollinger Band contracts, right here, as you can see, it's going straight. This is not a good thing, but always remember, contraction means 2 days in a row. Now this is the top Bollinger Band number, this is the bottom Bollinger Band number. Now right here, the top Bollinger Band number is 17.02, then it goes to 17.04, then it contracts, first day is 17.02, and the second day it contracts more. So you would wait for it to square it out. As it is contracting, so if you are trading, let's say, weekly contracts, and your contract expires, let's presume right here, then you won't be trading any more like weekly options contract. Why? Because Bollinger Band has started to contract. Once it contracts, it is bad signal. Why? Because contraction means it will stay within that band. So you can trade the like options contract, but you will be making only the premium profits, because the goal of bullish reversal strategy is the price should rise. And as it rose right here, once we put this like icon, let me put it up. Once we put this icon right here on this day, it rose. Brilliant for us, awesome for us. But remember, once it contracts, the party is over. You get out, you stay on the sideline, and you wait again for a strategy for like moving up like this. And then again you make money, and then again you stay out. So it's a simple bullish reversal strategy. You make money, on expiry you just square it, keep your profit, and again sit on the sideline. Find the stock to trade where it is trading, and no risk at all. So the strategy is simple. You need to get a stock that goes up. So once it closed up, you bought it, and it did went up. Brilliant. Next thing, if you are trading weekly options and it closed like under these 2 points, then you earn like really small profits, which will help you remove the commissions, because you need to pay commissions. So this smaller profit will act like a break-even point where you are not in loss, not in profit. So you can always trade a second like option contract. But this second, third, fourth, fifth, whichever like time you want to extend it, you can on the weekly expiry date. But please remember, once the Bollinger Band contracts, the game is over, the party is over. If you're trading a 30-day contract from the start, then even when it contracts, you can't like stay with your options, because you know it's far higher than your like buying point, the call option. So you have no risk at all. You will stick with it, and once the price like expires, once the option expires, you book your profits. So this acts as your profitable game, monthly profitable game. Now why I am saying monthly profitable or like income strategy? Because this gives you an income, and you can just sit and earn income each and every month. Example, you bought it here. This is October 5 and November 4 is this. So this presume is like 30 days. So on this day it expires, right? You made good money. Now what happens next? It again open higher. Once it opens higher, boom, you can trade again. Same strategy. You put it right here on the top, and you put it right here. That is below the top Bollinger Band contraction point. So it says 1580 lower and $18 as your call option point. Now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Now as you can see, right here the first Friday would have come. Right here the second Friday would have come. You are in profitable. If you have booked the profit right here, you can again make it a trade. It's as simple as that. And you can continue to make the trade. If you are like using the 30-day expiry, you again like continue with it. Now as you remember, we traded it right here on this day. This is November 9. So around December 10, it expires, the 30-day period, if you're trading the 30-day period. And December 10 is 7. Wait a minute. I can't see the date. 8, 9. And this is the 10th day. Yeah, this is the 10th day. So on this day, it expires. Now this D means the results came in right here. it gave out a dividend of 0.08 cents. Now my point is that we bought it here and it stayed above our point. So if you were trading at a 30 days expiry period, it would have been great. Even if you were not trading, we would have simply booked it up from this end to this end, and it would have been a brilliant profitable stuff. If you would have gone to expiry of 30 days, then we would have a catch on this result season. If the result would have been bad, it would have maybe fall off to a point. But if you remember, we are trading American options, which means on any day we can square this transaction either here, 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 or here, or on expiry right here. It can be used at any day we like. So if it does something bad, then we square it up and make a smaller profit, but a profit. The best thing. So this is the learning point, that the price should always end above the Bollinger Band. Then you trade these risk reversal strategies. Now you are in bullish risk reversal strategy, so your point is that the price should move higher than the Bollinger Band. Once it does, you make money. No problems at all. You bought it here, you sold it anywhere you like. The point is to trade intelligently. Now I have designed this system after many losses, and this system works. If you have doubt, just test it on any time you want. Use my strategy that I am discussing right now and check it out on any stock you like, and you will find that it works. It works almost all the time. The best part, you have everything covered. If the price comes below, in between the band, you still make money in a bullish risk reversal strategy. If it goes above it, you get tons of money. How? We bought it at 18, if I remember it right. Yeah, right here at its high, 18. And if we put it at 30 days expiry, that is 22. That is $4 profit. $4 multiplied by, let's say, 10 contracts would mean around $4,000 profit. Now just consider it. $4,000 income for 1 month. Isn't it awesome? And what is your risk? Nothing. Even the earlier trade that we made, it even ended on a 30-day period at a higher point. Even if it doesn't end higher, it comes back down. Then even you have no problem at all. You can simply square it up. You can simply square it any day you like. But if you are squaring it on any day you like, then you can claim this call option, but this put option will remain there. So it would be like a risk left. So if you're squaring the call option by claiming it and buying it right here at this price and selling it right here on any day you are applying it, so this will remain. So you need to square it out. On that day, simply buy an opposite of this put option and square it out. You have bought this put option, sell a put option again at the same price. You would be you would need to pay a few cents on this trade, but it's not that bad if you are trading before the expiry date. Otherwise, on expiry automatically it will expire and this will be in profit. So if you want quick profits, let's say you can trade weekly contracts. On every end of the week, this will expire and this will be in profit. And that's it. You trade once more, either on this stock or any other stock. You simply need to check it each and every day. 15 minutes. Just check out 5 different stocks that you like, that you are happy to trade. Just check them out. On any stock that you find it this, it goes up, simply jump into that stock, buy it, make money. So it becomes your passive income. Every month you've generated an income and it went into your pocket. So you don't need to like have any risk. It's a simple strategy. You bought it, you sold it. You bought it, you sold it. And if it doesn't move, like if it doesn't go above, you don't trade. Because if you remember, let me go back. Let me zoom out. Right here. If you remember, this was a period from here, this is July 18th, till here, October 5. That's July to August, August to September, and approximately September to October. That's 2.5 months where you didn't trade Bank of America. Now, this could be no earnings, but no losses as well, and no problem as well. So the strategy is monthly safe income. We missed these 2.5 months, but we missed it for a reason. We don't want excessive risk trades. Now, if you take any other course on Udemy, they will all tell you the strategy. That's it. And this risk reversal strategy is not even available. And even the other strategies that they tell you is only like strategy. You do this call option at this rate, this put option at this rate, and that's it. But there is a risk. If you trade it right here, top and bottom, it will simply fall off. Example, let's presume you put it here and you put it here. It will simply fall off and you will have huge losses if it goes below this point. Right here, you are in huge losses. Right here, you are in huge losses. So why take huge losses? Why not trade a simple strategy that gives you monthly income, profitable income, without like huge risk? We missed 2.5 months. But once we traded, we made huge money without any problem. So why not trade a far lower risk strategy than trade a problematic strategy? Thank you.